Hi guys, Will here from WB Trading and welcome back. As always, if you are new to the channel, please do hit that subscribe button and tap the bell icon so that you don't miss any of the free content that I share with the trading community here on YouTube. So today, let's dive into 7 things I wish that I knew before I started trading, and hopefully I can help you avoid these, build on these, and become a more successful trader via steering around them. So let's dive straight in with number 1. Start small, remove the pressure of managing live capital, and focus on edge and execution. So let's break this down. Start small. Now, it's no secret, is it, that when you have a larger account and a trade goes well, and you're staring at that larger P&L, staring back at you, it feels incredible. But before you know how to actually manage this, your natural instinct is to grab at the money, get the trade closed out as soon as possible, crystallize the win, get the money in the bank, and move on to the next trade. And a lot of new traders will no doubt think that's what trading's all about. Just, get the trade moving in your favor, into profit, grab it, bank it, and done. Right? But that's the problem with starting too large. The psychological pressure of seeing big numbers up, big numbers down, with no structure either leads to the account being blown or just some questionable tactics and mistakes. In fact, I was literally actually chatting with a trader about an hour ago who was talking to me about how up to now he's been martingaling, which for those of you who don't know about that already, it actually means that when a trade goes against you, you add to it. And then if it goes against you again, you add in some more, and on, all the way down until hopefully it eventually comes back up in your favor. The problem is, of course, when it doesn't come back, your account is heading to zero and it's game over. Now, thankfully, that hasn't happened to him yet, and it won't now that we're getting him started with my strategies, but it was only a matter of time before it all went wrong. So coming back to my point though, and I've tweeted about this in the past, if you start small, so small that the actual financial gain doesn't overly impact you, it allows you to focus on trading well, executing well, following your strategy to a T consistently. And if you take a loss, again, no problem. If you have a win, it feels great, but you aren't jumping for joy and becoming elated and then subsequently oversizing your next trade and so on. Because the win is fairly small, again, you can maintain focus, carry on trading well without that huge psychological pressure on your shoulders that comes with a much larger account. And as backwards as it sounds, and you'll know this if you've done this yourself, the results come via this method, via trading small and growing steadily. And again, they tend to come much faster and with way less anxiety, way less stress, way less up and down, and so on and so forth. I'd really recommend giving this a go if you haven't. Open up a small but viable account, maybe £500, £1,000, whatever you can comfortably afford to risk, and just separate yourself from the money. And the thing is, if you open up let's say a £10,000 account from the off, it's going to play on your mind because, that might be 6 months of expenses. That might be the car paid off. So you'll be way too attached to that amount of money. Whereas if it's, let's say £500, that's a weekend away or a holiday or a month's mortgage payment, isn't it? Losing it isn't going to mean you're homeless, you're starving to death. So again, you can separate yourself from that and via that, trade well with that capital. Give it a try. So number 2, focus on a select set of strategies with complete long-term focus, no strategy hopping. This is the absolute killer. It really is. And we've all been there. We've all experienced this. You begin with a strategy on a losing run, you decide it doesn't work, and lo and behold, the next trade, the one we don't take, is a big win that we've now missed out on. I've seen it time and again, and I did it myself back when I started out too. The point is, you have to commit to a strategy for at the very least 6 months, in my opinion. Take 100 trades with it, take 250 trades with it, execute well and log the results. If the strategy works, you're going to make money across 250 trades, even if there's some kind of meltdown in the middle. It's critical to let Hedge actually play out. So whatever the strategy, whether it's a long-term trend following strategy or a short-term counter trend strategy, whatever it is, it will have bad weeks, it will have bad months, it will have bad quarters, and so on, but just bear with it. There seems to be a myth that professional traders just consistently make money day in, day out, consistently forever. It's just not the case. Now, are there traders out there who are profitable almost every day? Absolutely, there'll be outliers, yeah. Are there traders out there who mainly take small losses regularly and then get pulled back up and out of this by an extremely large win every now and again, but whose trade records look like a bloodbath? Absolutely. And everything in between. But what's the difference here between them, those profitable traders, and others? The difference is they stick to their strategies consistently, month in, month out, year in, year out. That's the difference. They focus on their strategies with complete long-term focus. Also, just very quickly, if you are enjoying the video today, it'd be really great if you'd hit that thumbs up button. That would really help me, if that's okay with you. So number 3, implement rules with a clear, concise methodology to remove self-sabotage. Self-sabotage, it's the killer, isn't it? Again, it stems from what we've talked about already. Having an account that's too big for you to handle mentally, strategy hopping, and so on. So how can the problem be solved? Well, think about it. Let's keep this simple and say that your trading methodology is support and resistance. So you come in every day, you look for key levels, and you either buy them or you sell them. And we know that this works too, as long as you've studied charts for 5, 10 plus years. But for those who don't have a spare 10 years to practice and refine their chart reading skills, you're going to second guess yourself. You're going to see a level here, see a level there. You're going to have lines all over your chart. You're going to take what you think is a high quality trade and take a loss. You'll skip what you think is a lower quality trade and it'll turn out to be a win, and on and on. That's the problem with using discretion and using guesses and predictions. So what's causing the mess and the confusion there? It's obvious, isn't it? It's not having a clear, concrete methodology and having rules in place, not having a mechanical process. See, it's obvious, isn't it? If you have a concrete methodology and mechanical rules in place to follow consistently, you can't really go wrong because you've either followed the rules or you haven't. And the great thing is this allows you to look back on setups without having to label them high quality or low quality, because the setups are either there via the rules or they aren't there via the rules. And it's having this mechanical process in place that more often than not leads to results. It's following a process that leads to results. Think about it. Let's rewind back to high school when we dissected a frog or did some kind of experiment in science. What did the teacher lay out on the blackboard? Rules, a methodology, a process, right? He didn't just say, right, look at this frog, let's cut it open. I'm not really sure how or where we should cut it, but let's just slice it open and see what happens. No, they know exactly where to cut, why they're cutting there, what will happen when they do it, and so on. It's all mapped out, it's completely mechanical, and more importantly, it's completely repeatable, it's systematic. You know, that trader knows the results, and he'll just repeat that process with every new class of students he's given because he knows that it works. And trading's no different. If you just roughly understand some analysis and you have a rough idea about, let's say, supply and demand, good luck with that, because you're about to just randomly slice that frog open and hope for the best. And blood is probably just going to squirt in your face in front of the entire class of students, isn't it? It's not good. You need to implement rules with a clear, concise methodology to remove that self-sabotage element, remove the stumbling blocks, remove the guesses and the predictions. And with this, with that set of rules when followed, this then removes that self-sabotage element completely and it leads to results. Number 4, focus on risk. So this is the big one. And I don't need to share a huge story here, but what I'd add is you can't trade with an empty account, can you? You need capital to deploy. You need ammunition, right? And if we come back to needing to execute long term as your edge plays out, if you're risking, let's say, 10% as an example, and you've split this across 10 trades, all the same size, then you have 10 swings and you're out, right? Same for 5%. Let's say you've split this across 20 trades, all the same size. That means you have 20 swings and you're out. Account empty, game over. Now, as we all know, it's not quite that black and white, but you understand what I'm saying here. You have to conserve capital to keep you in the game long term. You have to be able to weather the storm through the inevitable bad times and so on. You have to give yourself the time to make mistakes, to learn, to grow. Imagine you're about to, let's say, begin learning to play football. So you and 5 friends. On week 1, you break your leg. And 6 months later, all your friends are getting results, they're mastering the skill, but you left early, you've learned nothing, and you've gotten nowhere. It's kind of the same if you blow an account. You're going to be out of the game, whilst everybody else who kept at it is going to grow, keep practicing, keep learning, and they'll get there given time. So don't go and break your leg in week 1 or month 1 or even year 1 as a trader. Don't empty your account. Keep risk small, manageable, consistent, and make sure that you're able to stay in the game long term and carry on playing. Number 6, leave your trades alone. Many of you will know what I mean when I say this, and again, I've done it myself. I've made all of these mistakes myself, and it's so incredibly annoying when you exit early and then watch your trade continue to move in your favour. And in a way, this comes back to discretion versus mechanical trading, doesn't it? I actually think it's much more painful when you have rules in place and then you break them, because you're then able to see where the trade would have given you an exit signal. Because if you're trading using discretion and you're basically building your trading career on guesses and predictions, you never truly know where you should get out of a trade. So if you're going that route, you're pretty much going to be beating yourself up over early exits for life. But for those of us with rules in place, we have it easy in regards to trading because we know exactly where to get in, exactly where to get out. But again, when rules are broken, it's then all the more painful because we're able to actually see what would have been had we stuck to the rules. And in fact, I've got a great example of this. Let me share some feedback from a trade on mentoring at the moment, Ava. Let me share her story with you really quickly. Now, this woman had tried everything before she found me. She'd done all of the trading courses, she tried all of the strategies, and in fact, there was actually only one thing left that she hadn't tried, and that was trading mechanically using rules. So she found me, she came on board with me roughly about a year ago now, and so far she's turned her initial £500, again she started small and manageable, into now just below £2,000. I think she's at about 1,970 odd, if I remember correctly, after looking at a trade record a few days ago. And she says it herself here in an email that she sent to me: follow the system, stick to the system, or in other words, just execute well and leave your trades alone. From there, the results just come, and she's yet another example that that's true. And for those wondering, she's actually a platinum package member, so she has all of my strategies. So lastly, and I'll keep this one short and sweet, think long term. If you take a loss today, don't beat yourself up. They happen to us all. If you have a down week or a down month or even a down quarter, try and look past it, because it might be your last down quarter for a year. Obviously, you can't see that because, look, we can't predict the future, but as long as you're managing risk and trading with Hedge, you will come out ahead in the end. As an example, let's take trader Bill Dunn here. Now, this is a chart of his long-term performance, and if we take the period between 2004 and 2008, and this is a frightening example, but he drew his account down for 4 consecutive years before they're making new equity highs in mid-2008 and then beginning to, as you can see, bounce back from there. His average account drawdown across this entire period was minus 38%, and yet look where he ended up, having stayed consistent, stuck to his strategy and carrying on, executing well. Now again, that's an extreme example, but it's a real life example nonetheless. There'll be bad times, there'll be good times, but if I could only share one piece of advice, especially to wrap this video up today, it'd be this: think long term. Anyway, I hope that helps. I hope that's added some value for you all. I'll leave it there for today, and as always, trade with Hedge, with consistency, and I look forward to having you back here on the channel soon. Thanks everyone.